In the last episode, we looked at trade credit insurance for open account sales and why the policy details matter before shipment. That raises the next practical question. If an exporter has foreign receivables and some of those receivables are insured, can those invoices become usable working capital? The answer is sometimes, but not automatically. Receivables financing depends on which invoices are financeable, what controls a lender requires, whether the buyer and country exposure fit, and whether the insurance structure actually supports the collateral. In this episode, we will look at how export receivables financing works, where insured invoices can help, and where borrowing base assumptions can break down. The working capital problem starts with timing. An exporter ships goods or performs services, invoices the buyer, and then waits for payment under the agreed terms. During that wait, cash is tied up in the receivable. The exporter may still need to buy inventory, pay suppliers, fund payroll, or accept the next order. Receivables financing is meant to close part of that timing gap. But lenders do not usually look at a receivables book and treat every invoice as equal. The question is not just how much has been billed, it is which receivables are eligible, collectible, documented, controllable, and strong enough to support an advance. It helps to separate the structures. Factoring usually means a finance provider purchases receivables, often with its own credit and collection controls. Invoice, discounting, or asset-based lending usually means receivables support a borrowing base, while the exporter keeps more of the customer relationship. Buyer-led supply chain finance is different again, because the buyer's approved payable process may drive the financing. EXIM-backed working capital support can also sit around eligible export activity when ordinary commercial lines are constrained. These tools solve related problems, but they do not create the same risk profile, economics, control rights, or operational burden. Lenders care about more than invoice face value. They look at buyer quality, country risk, payment history, invoice aging, concentration, dilution, disputes, documentation, assignability, and collections control. They also care whether the underlying sale has performed cleanly. A large receivable may be weak collateral if the buyer can dispute acceptance, if documents are missing, if payment is blocked by local restrictions, or if too much exposure sits with one buyer or one country. This is why borrowing-based conversations can feel conservative. The lender is not financing revenue in the abstract. The lender is financing a controlled pool of receivables. Trade credit insurance can improve the conversation when the policy fits the receivables and the lender understands the coverage. It may help address covered buyer non-payment risk, support credit discipline, or give a lender more comfort around an eligible foreign receivables pool. But the policy still has to be usable in the financing structure. The lender will want to understand approved buyer limits, exclusions, waiting periods, claim procedures, loss payee or assignment provisions, reporting duties, deductibles, and what happens if the exporter violates policy conditions. Insurance can strengthen a borrowing base. It does not replace the borrowing base rules. This is where insured invoice assumptions break down. An exporter may assume that because an invoice is insured, it should be financeable. A lender may disagree if the buyer limit is too small, the invoice is too old, the sale is disputed, documentation is weak, the country risk is outside the facility appetite, the policy notice requirements have not been followed, or the receivable cannot be assigned cleanly. The problem is not that insurance has no value. The problem is that insured, collectible, eligible, and financeable are related concepts, not synonyms. The structure has to connect them deliberately. EXIM working capital support can matter for qualified U.S. exporters, especially when foreign receivables, export inventory, or performance needs do not fit neatly inside a conventional bank line. But it is not a universal answer, and it should not be treated as automatic eligibility. The exporter, lender, transaction, country, end use, documentation, and program requirements all matter. In the right case, EXIM support may help a lender extend capacity against export-related collateral. In the wrong case, it may be irrelevant, unavailable, or less efficient than another structure. The analysis should start with the transaction and the cash need, not with a program label. Before signing a facility or assuming receivables can fund growth, exporters should ask direct questions. Which buyers and countries are eligible? What advanced assumptions are being used, and what could reduce availability? Are insured receivables assigned properly and reported correctly? Who controls collections, and what happens when an invoice is later disputed? Are concentrations, aging, exclusions, and documentation gaps monitored before they affect borrowing capacity? Impello helps exporters evaluate these questions and navigate the advisory path. We do not replace banks, carriers, counsel, or internal finance teams, but we can help make the financing conversation more disciplined before the receivable becomes a problem. The takeaway is simple. Receivables financing can help exporters turn invoices into working capital, but only when the collateral is real, controlled, documented, and eligible under the facility. Trade credit insurance can be an important part of that structure, but it does not make every receivable bankable by itself. The useful question is not whether invoices exist, or even whether some invoices are insured. The useful question is whether the receivables book, insurance policy, lender controls, and export cash flow need all line up. In the next episode, we will look at performance risk and contract execution. Why getting paid also depends on how the export sale is documented, delivered, and accepted. Subscribe so you do not miss it, and leave any trade finance questions you want us to break down next.